Who here doesn't dream of hitting it big with a smart investment in an initial public offering? From Slack to Lyft, Uber to Pinterest, we've seen a number of high-profile companies go public in 2019. But in my mind, the standout IPO so far this year has been Zoom, the business software firm now among the most valuable cloud companies in the world. Zoom listed on NASDAQ, which is where we're filming this episode of Looking Ahead. I'm Al Dominic, your host, and I'm at NASDAQ's market site in New York City to explore what private company boards should be talking about if they are considering going public. With me today are Kathleen Smith, the co-founder of Renaissance Capital, and David Wicks, VP of Corporate Services here at NASDAQ. Each brings considerable experience with the global IPO market, and we're going to explore issues that involve institutional investors, investment banks, and advisory firms. We'll get into how investors uncover and profit from IPOs. And we'll look at the pros and cons of moving from a private company to a public one. So Kathleen, as a founder of one of the leading pre-IPO research and investment management companies, what should private companies know about going public right now?
Well, certainly the current IPO market is pretty good, so it's a good time to go public. But I would say it takes some time to put an IPO together, so you need to have a strategy about how to address a market that can be pretty fickle when it comes to new companies. So you want to have your business set up on a sustainable path so that you can deliver to investors what you're telling them about your business over time. So I'd say the important thing is to have the business on a sustainable path.
Okay. And David, given your role here at NASDAQ, what are some of the industries that have been active so far this year?
Yeah, so 2019 has definitely seen strength in the technology and biotechnology industries. So far this year, we've listed 50 new companies, capturing 81% of the market. And, we definitely see, when we look at our pipeline versus last year, we see a 20% increase in that pipeline. So we definitely feel that this IPO market will continue to be strong in the foreseeable future.
Sure. And Kathleen, you look at this from a research standpoint. Why do you think this is the case?
Well, both research and we're seeing quality companies come to market, primarily. The valuation, the price discovery has been pretty good with this IPO market, but we would say that you can look at returns are almost everything. If the IPO market is producing strong returns for investors, then the door is open for IPO. So you can look at the Renaissance IPO ETF, and if you see that performance being strong, that means investors in already public companies are making money, and that would be a clue to tell you that this is a good time, the waters are warm, you can jump in and do an IPO.
Yeah. So let's go back maybe 20 years. At 99, 2000, that's kind of the height of the last big IPO time, and then the bubble burst, right? So there's some scars that I think are still being felt. You want to maybe talk to me a little bit about how 20 years later we're still impacted by that time?
Having lived through that time, I'm happy to comment on it. We may feel that today's market is a bit frothy, but it's not nearly as frothy as it was in 99, 2000. And also the constituency of investors are different. Back in 99, 2000, there were a lot of individual investors who were jumping in with both feet regardless of price. So we saw the average first day pop for IPOs somewhere between 50 and 70%, and issuance was very robust. These days now, ever since that time, the average first day return on IPOs has been more like 15%. So we have a much more rational IPO market with more sophisticated players that care a little bit more about price discovery. Yep. It's not to say we don't have momentum, but it is a different kind of market with a smarter investor.
And Al, if I could also add, I think one of the important things to recognize is that the average age of a technology company going public back then was only 4 years, being 4 years old. Today, that has actually become 10 years. So companies are definitely more mature as they go public. I think the other thing to acknowledge is, yes, there were clearly companies that, through that dot-com bubble, are no longer with us, but it also produced some amazing companies. So you look at companies like Amazon and eBay and Bookings Holdings, which is maybe better known as Priceline. These companies were part of that revolution that were part of going public during that period.
Right. So it seems that investors in IPOs have changed. And if that's the case, how can a pre-IPO company start to build some trust with this potential investor base?
Well, I think it's very important for companies to realize the job they have to do when they're public with getting to know and be aware of the investors that are involved with their company. Sometimes it's hard for a company to realize that that is their job, because if you go public with an investment banker, they tend to handle so much of it at the beginning. So the number one job the executives of the company have is to understand their investor base and to build it, to give it the time. The IPO process can be fairly rushed when it comes to talking to investors. We suggest take the time, make sure it's an opportune time to meet investors, get to know them, and deliver on what they're expecting. And you'll have a very good stock over time and a good relationship with the market.
Sure. David, you want to add to that?
Yeah, I would, definitely. And I think one of the things that we're very proud of is we own products and services that help companies, both private and public, be better companies. And interestingly enough, 30% of our clients are not public companies. So we actually help companies use the tools to help them, as Kathleen had mentioned, reach out to investors, understand analysts to target, start building that corporate governance infrastructure that is so important. Because if you think, if a company is a year out to going public, you don't want to be a month before and start building relationships, start building your corporate governance, start building that infrastructure. It really has to be done earlier on in the process. And we facilitate that with those pre-IPO companies.
Yeah. Well, back to what Kathleen was talking about in terms of communicating with your investor base, it strikes me that if you're successful in that regard, you're not going to see that group of people bail at the first sign of some type of weakness. So as much as the market goes up and down, I would assume that's where there's some great value to be recognized.
The idea is to have a long-term relationship with your investors, one of credibility. And as analysts that research IPOs as they're coming out and advising institutions, the biggest hole in analysis is not the numbers. It's not how the stocks are trading or the multiples. Is the management of this company going to do what I think they're going to do? Can I trust them? Now, once a company's already public, you're meeting with investors, you're producing your quarterly results and having that dialogue. So the key thing is, as researchers, is how do we guess who is going to be good and who's not? Who can deliver for us? So we try to kind of read the tea leaves early. The management that has this under control will have a much better IPO than those who aren't focusing on that.
Yeah. Well, it sounds like we've got a more sophisticated group of companies that are considering, taking the plunge. So I'm curious, how come it seems like the time to go public has maybe lengthened, or maybe the regulatory review process has been changed somewhat?
Well, we look at there is a long time you're preparing in registration, but as investors on the buy side, we think it's a very short period of time that we're seeing the information we need. Mm-hmm. We have less than a month. Half of the time we're seeing a prospectus that has a lot of things in, but still a lot of blanks. And we see less than 2 weeks time to look at these numbers and actually judge what we think these companies will do. If it were up to me, we would give a little more time for a fully filled out prospectus to be completed. And that can be someone under control of the company moving forward. That doesn't have to be as fast as every benchmark is required. But I would say from an investor standpoint, it is a much shorter time than it's ever been. We used to get a prospectus and hold on to it for several months before going public. So on that, it may take longer to prepare, but it's a lot shorter when it comes to addressing investors. And that's a concern we have. We think that the company should give investors time to study them and look at their information. Otherwise, they won't make a solid decision about and be a long-term holder.
Yeah.
They need to be informed.
Well, you talk about concerns. Maybe to wrap things up, David, what are your concerns for a healthy IPO market to continue?
Yeah, so I think, look, clearly right now the environment is good, right? We have low volatility. We have, we're starting to see earnings that came out yesterday. GDP seems to be good, stable interest rate environment. So all these things lead to a good environment for companies to consider going public. I think where, we worry a little bit about is one, U.S.-China trade deal, definitely the market doesn't like uncertainty. The faster that can get resolved and put to rest, the better. I also think, volatility, right? So if we see volatility coming back into the market, whether that's through geopolitical risk or, another factor, that would certainly be a concern of ours. But I do think that as we get closer to the 2020 election, you are going to see companies that are going to want to get out before that potential uncertainty of what that could bring.
Sure. Kathleen?
My concerns primarily about the IPO market is that we get very good price discovery. We don't want to see trading that is far beyond what is logical based on the company's existing business. So we worry when IPOs trade up so high on their first day, whether they're underlying fundamentals that can justify that. So we're on the buy side. We want to see rational price discovery. If prices get out of control, pretty quickly when markets go down, those stocks collapse. So we don't want to see that. We saw the Lyft IPO. I think that's a very good IPO to study for companies that don't want to do it that way. This is a company that had tremendous amount of losses, a really interesting business, but so many losses and hard to analyze and understand when they're going to make money and how to value it. So for us, rational valuation is really important, and that the companies realize that it's not just a one-day event to go public. It is a long-term unfolding of liquidity and value for shareholders. It doesn't all happen on that one day. And the humility of knowing that, I think, would be very helpful to managements who are coming out and saying, I can't just totally judge myself by my stock price. I just have to focus on getting the business done and doing what I promise, and everything will be just fine.
Wonderful points. Well, I appreciate Kathleen and David sharing their thoughts with us. I'm Al Dominic, and thanks for looking ahead with us.